All right, good morning. So we're going to talk about some interesting stuff, but very, very important. We felt it was very suiting to talk about the current market volatility and what are the implications, especially here at TEXPERS, the great state of Texas, where this is a great example, this conference of a culmination of people coming together from local and city and first responder pension plans. And what's the importance of that? It really revolves around the influence that investment managers, consultants, and other groups have over the future of these pension plans. So let's see, I'd say for the last 3 decades, consultants, investment managers, and trustees have all been trying very, very diligently to consistently get the returns necessary to meet the obligations of the pension plans. And that's usually about a 7 to 8% annualized obligation. And the importance of that is to pay payroll. So if we take this little clicker here and move to the next slide, you'll see there's a lot of different options. We've seen extreme volatility, especially in stocks and fixed income. That volatility has challenged the returns and in some cases set back the returns for these public pension plans. And that's critical because if we're not a net positive cash flow or the overall plan, then we're actually going backwards, and we always have to try to stay at an annualized rate of 7 to 8%. So when you have extreme volatility and you go backwards, you actually have to work that hard to get back ahead. Sometimes you have to do double time or more, which is what's been going on lately. So if I talk about pension plans and the public pension plan background, and we look at this, you can see that 13.8% of the total U.S. workforce is part of public pension plans, right, or state and local employees. But 25% of this workforce does not have access to Social Security. This also emphasizes the importance of the pension plan performance. It's 66% of firefighters and police officers do not receive Social Security, and 50% of teachers do not receive or have access to Social Security. We also know, and we've seen it with our relatives, our family members, and otherwise, that life expectancy continues to go up. So back in, I think it was 1970, life expectancy, or 1960, life expectancy was 70 years. And it's actually, as of a couple of years ago, moved up to 79 years, and it's projected by the Labor Board or Bureau to 2060 to go up to 85 years. So that means obviously people are living longer, which further stresses the importance of meeting these return objectives. Because if we fall short, we have longer lives, we have more funding to do, and so forth. So very, very important discussion here today, and a very important responsibility that we all have as trustees, consultants, and investment managers. So this right here is a public pension investment scale. So this is pretty daunting if you look at this. If you go from over the last 20 years, state and local pension plans went from basically $2.04 trillion under management, and it's gone up 2.5 times in the last 20 years. So now we're managing about $5.1 trillion. That's a lot of money to manage, so it's a lot of responsibility. And just to give you a feel for that, that's a compounded annual growth rate over that period of time of 4.5% per year. So it's a lot of responsibility. So right now, this is the public pension plan investment asset mix average across pension plans. Now this is very, very important and probably one of the key fundamentals to this discussion here today. As you can see, the lion's share of that is still in equities at 47%, fixed income is at 22%. There's been an increase in movement towards alternatives such as real estate, private equity business, timberland, cryptocurrencies, and other types of alternatives. But in our opinion, and the opinion of a lot of folks that are watching performance across pension plans, maybe that shift away from equities and fixed income should be happening at a faster rate. And the reason for that, I'll just give you a feel For this 20 years ago, equities represented about 58% of all investments. So that's now only 47%. So that's moved more towards alternatives. Fixed income was at 30, I want to say it was right around 32%, 33%, also a decrease in fixed income. And there's been increases in alternatives. So real estate 20 years ago represented about 3.6. It's now 8%, as you can see. And then we can also see here that private equity, which is now at 11%, went from like 4.5% or something up to 11%. So again, a gradual shift in the equity or in the allocation mixes away from fixed income and equities and towards alternatives. And we'll get to the reason for that, and it's very, very important to see that this is happening. And just to put this at a bigger picture, 20 years ago, alternatives only represented 9% of the allocation mix, and now that's up to 29%. Okay, so gradual movement away from equities and fixed income towards alternatives. And a lot of that, if I think about the overall thesis of what I'm talking about here today, it's relative to the ability to have influence or control, or more control, over the investments and the investment thesis or business planning of how those investments will perform versus having no control. So this here is just a graphic display of some of the stuff that I talked about. You can see in the top purple line there, equities 20 years ago, like I said, was at 57%. It peaked at about 61%. Now it's 47%, so trending down. Investments in fixed income also trending down, and then the alternatives, it's a gradual, slow trend up. But the question today is that trend happening fast enough based on the volatility and uncertainty that we're seeing in the more traditional investments of equities and fixed income? So this is public pension investment cash flow, and this is over the last 20 years. So this is not necessarily good. If you look at this, you can see that it's been anywhere from -2% on average to as bad as -3.25%, almost 3.5% over 20 years. So that means the funding is going in the wrong direction. It's not going in a positive direction. The goal is always to have it above zero in some positive direction so we can meet the long-term obligations. So we look at CalSTRS. CalSTRS is California State Teachers Retirement System. It's a great real-world case study. CalSTRS represents $302 billion in investment capital, and so whenever you're managing that type of money, obviously there's a lot of intelligent people that should be involved in those decisions, and also governing what is the right allocation mix to get the returns for their constituents. So if we look at their year-over-year ending in June 30th of 2022, it was -1.3%. And where was the action, if you will, positive or negative? So if you look at return in public equities over the last year for CalSTRS, -16.6%, fixed income -10.3%. But look at the outperformance that came out of alternatives. So real estate last year for them was up 26.2%, and the returns from private equity business were up 23%. So we talked earlier about that gradual transition, right? And I'm including other things in alternatives that are really good at investments like debt. There's great creative alternative debt that's out there as well that's done really good and consistent, and I would say, you know, averages in that 12 to 15% range as well, which is also a good solid foundational component to the overall asset allocation mix. So you can see the high performers were the alternatives, and that may be driving this gradual movement towards alternatives. I personally think that it should be happening at a faster rate. You saw on the average allocation mix that the average allocations for most plans, for example, in alternatives versus equities was 47%. So CalSTRS, their mix in public equities is 38%, so 10% less than the average. Fixed income, they're at 10.5%. dedicated to fixed income. Their real estate is at 16.3%, so they have twice the amount of real estate that the average group does as far as the allocation mix. And in private equity, they're at 15.7. That's about 50% more than the average allocation mix. But if it wasn't for those alternatives, they would have been much lower performance or much worse performance than the negative 1.3% on the year. So again, this data we're talking here is long-term. The trends are over 20 years of the shift of allocation mix, and it's something that should be taken very, very seriously. So this is volatility and its influences, and what are the things that influence us in today's world. And in most cases, other than things, outliers like COVID and some of the things up there, the war in Ukraine and so forth, have been around for a long time. So we have government regulation, ESG, and a lot of environmental requirements. These have costs to them and drive up the cost of investments. Inflation, as you know, year over year has been about 9%, so a lot of people are trying to do different things to hedge against inflation. So that can have a very meaningful impact. For example, if you talk about real estate, if the inflation rate is at 9% and you're not able to push your lease rates or your rental rates above 9% during that same year, then that real estate value has gone down. But one of the things about real estate, especially if it's privately held, is that you have these capabilities of pushing lease rates yourself and moving that up above inflation to make sure that the value keeps going up. I mean, in some apartment complexes, for example, that we own, I think in the last year we bought about 14 or 15 different apartment complexes around the country. We pushed lease rates on an average of anywhere from 15 to 50% in the last 12 months, increasing significant value and outpacing inflation. But we had the ability to do that because it's an alternative that's privately held, and we don't have the pressure, or we don't have to deal with the Wall Street performance expectations, which are reset basically every quarter. We have the luxury, as does private equity business and long-term debt or even short-term alternative debt, to have business plans that maybe have a 3 or 5 or even 10-year view. So we're not forced to react or overreact to volatility that's out there. So the other things, obviously, war in Ukraine, that has a lot of things to do with supply chain, access to things like wheat and fertilizer, and then it cuts off a lot of access to oil and so forth in Far Eastern Europe. COVID obviously had a lot to do with the productivity and the capability of people to be productive. It restructured a lot of things, impacted office, for example, office usage. Social media, when it comes to influencing the public markets, is very, very interesting because there's no accountability. So, for example, with Twitter or things of that nature, you can say whatever you want about a company. It could be true, it could be false, but there's no accountability. And if it's false and it gets traction and others pile on, then it could start the movement of a stock in the wrong direction. And if it starts a movement in the wrong direction, and then you have high-frequency traders jumping on the bandwagon and moving big blocks of stock, all of a sudden the value of that stock has gone down way too fast and very significantly. So, there's periods of time where, during COVID, I think in 2020, the stock market went down about 57%, and that's pretty alarming, where other asset classes that weren't tied to public markets didn't have near that type of vulnerability. So this here is bond yields, and as you can see, the bond yields have been low. You can see they've averaged between 3 to as low as 1.5%. Now this is very interesting because bonds and interest rates have an inverse relationship. So when interest rates go up, bond values go down. So for example, if new bonds are issued at higher rates, then the older bonds that were already out there are worth less. If your bond isn't performing at 9% or better, based on what we see with inflation, then that bond's value has gone down. And typically we've used bonds as a staple, as a kind of a fixed income, reliable, stable out there for us, to help us with liquidity. And that's part of the reason why there's so much invested in equities and fixed income, is for access to liquidity. But for example, as I mentioned earlier, if you have interest rates that are going up and putting pressure on bonds and forcing the value of the bonds down, if, for example, in real estate, what you can do is you can just increase the lease rates. In businesses, private equity business, you can actually increase the prices of the goods you're selling to offset the increases in inflation. You don't have that flexibility in bonds. And that's a kind of a big issue, especially when bonds in general, it's very rare that bonds perform at that 7 to 8% that's required, right, to meet the ongoing obligations. So sometimes you'd ask yourself, well, why do we have bonds at all? Again, it's a liquidity, safety net, if you will. But in general and in concept, it doesn't even meet the annual targets that are out there. So this is the VIX Volatility Index. So higher numbers on this index are not good. That means there's a lot of volatility. If this is a 2-year look, you could see it's like a whipsaw of volatility over the last couple of years. When there's more action, the volatility index goes up at a faster and drops down at a more alarming rate. So this is what's been happening in equities over the last couple of years. Now we look at real estate as an alternative. Real estate is historically much less volatile. This is a 32-year look at real estate. Real estate only had 2 periods over 32 years, one coming out of the S&L, which was down about 6%, and then one coming out of the credit crisis or recession of 08, 09, which was down 20, I think it was 26%, 27%, something along those lines. But out of 32 years, there's only been 2 down periods in real estate. Now, the next slide here is really going to give you a feel for, this is a video I'm going to show you. A lot of people have been, watching and seeing what's been going on with real estate around the country. And you've seen a lot of bidding going up and craziness where people are paying cash and closing, on a week, or, overpaying by 20, 30% above asking price. But this will give you a feel of what's been going on in real estate.
Excuse me, is that Apple for sale? Yeah, we're about to put it on sale right now, actually. Well, I'm in the market, so tell me about your Apple. Why should I buy it? Nice try. Okay, people, here's how this is gonna work. I have an Apple here. The highest bidder's going home with this. I want all bids in the next 2 minutes, then we're closing it. Bidding starts at $5.
Feeling pretty confident there, huh? I mean, don't you think?
$10.
He said starting at 5.
15.
Is this a new Apple?
Yeah, just listed. I'm pre-qualified. I'll pay cash. I got cash. 20, 30, 40. No, just make it 45.
Is it even worth that?
50. I don't know. Please, this is the 8th Apple I've tried to buy.
Could I at least see it up close?
Nope, it's an Apple. You know what it is. You either want it or you don't. I'll take it for 100.
What? I'm from California. It's the cheapest Apple I've ever seen.
120.
Why did I do that? Why? I don't.
So that's real world in real estate. We see it as a buyer and a seller. That's the type of activity that's happening, especially when there's demand. And if you're in high demand markets, that's really important. So let's look at apartments and a performance in apartments. So in apartments, we're taking a look here at the last 12 years. If you look at total returns, there's only been, if you look at total returns, there's never been a negative year in returns for apartments. Now this is unlevered, which is very important. And so apartments have averaged anywhere from 5 to 25% returns unlevered, and most real estate investors use leverage. So obviously over the last 12 years, it's been a good performer. This yellow bar here stands for capital appreciation or capital return, but from an income level, every year over the last 12 years, property income has been positive. So what that means is that as long as your income is greater than your expenses at the property level, it's a positive investment from an income month over month, year over year basis. Capital appreciation is is the overall view of the value of the asset itself without regards to the cash flow. So it's more geared towards what the market thinks that building is worth. And so this was the only down dip here was as a result of COVID, but the overall returns have been positive for 12 years for apartments. So happens to be a very favorite apartment or asset class for us. Part of the reason for that is apartments are places where people need to live. They provide a real, tangible need. Some people prefer apartments over homeownership, and some people who can't afford homeownership will obviously take the apartments. So one of the things, though, I'm going to go back here real quick. If you see this line here, you see this line here, whoop, sorry. So this line right here is a cap rate, right? So it also has kind of an inverse relationship. So this cap rate means that the value of apartments in the eyes of buyers for apartments have gone up. So the cost of the apartments have gone up, which means people are willing to pay more for less cash flow. So if you're wondering why that's going down, that's actually a good thing, meaning those assets are worth more. So if we look at industrial, and this is another favorite asset class of ours, we're getting ready to buy about another 1.1 million square feet of industrial by the Savannah Port. You could see over the last over the last 12 years, every single year has been positive, and that's been on average between 10 and 50% IRRs, and that again is unlevered. So the returns can be much higher. I mean, we have some exits going on right now where the returns are in apartments as high as 90% IRRs. We have some industrial products that are selling at like 40% IRRs right now. So real estate drivers, again, alternatives that allow for business planning and more patient activity. They're backed by contract law. So for example, leases, people have the ability on both sides to execute a lease that is enforceable in the courts. So if somebody signs a 5 or 10 year lease, and if they break that lease, they still are obligated to pay that lease for the 5 or 10 years. Or they have to negotiate a settlement of some sort. So it has some more legs to it than what you would see, and more control than what you would see in a public equities environment. It provides stable cash flow. It's backed by a tangible asset that people can visit. They can go touch and feel it. They can walk the property. If you look at land, if it's very well located, it continues to be a very sought after asset that goes up in value year over year over year. And what's been happening lately at a very alarming rate that's holding off speculative development is the cost of new construction has been going up at an alarming rate of about 60% over the last 7 years and 30% over the last 2 years. So what that's doing is it's holding off speculative development and making existing real estate more valuable. And the reason it's holding off speculative development was because if people were to build brand new apartments or industrial warehouses or whatever, which they are doing, don't get me wrong, but they're not oversupplying the market because the lenders are concerned that there's too big of a gap for the cost of new construction lease rates versus existing comparable product lease rates. And that gap between those two is as much as 40 to 50%. So if we were to build like brand new apartments, let's say I'll just use Atlanta for an example, we would have to lease them at today's cost of construction at about $3,400 for a 2-bedroom unit. If we bought an apartment complex, which we bought some there recently, that were, let's say, 5 to 10 years old and in great condition, that same 2-bedroom apartment now leases for $2,600 a month. It was leasing for a year ago $1,600. But because of the demand and a lot of people relocating into these markets that are higher demand markets like Texas, Florida, Colorado, Georgia, the Carolinas, and so forth, Arizona, people coming from California, they're coming from markets where they're used to paying more. So it allows the lease rates to get pushed up at a higher rate. We look at private equity, real estate versus public REITs. Public REITs, for example, also have the same correlation to public equities. So when the stock market goes down, I would say it's very unfair that real estate public REITs or real estate investment trusts also go down, and sometimes at an alarming rate. The asset may still be 98% occupied, it may still be cash flowing great, but I'll give you a real world example. Sam Zell, who is a very famous real estate investor and a billionaire. I've been on TV a couple of times with Sam in the studios up in New York, and they've asked us about our views on real estate. And the difference is that he feels, and I agree with him, that he's unfairly punished, and he's predominantly apartments. So Equity Residential is one of the biggest REITs, if not the biggest apartment REIT. But in 1 week out of COVID, his apartment values went down 15.8%. And the values of private apartments went down 0. Because if there's nobody trading or selling in that period of time, then their value hasn't changed. But his value, because it was public and it was a REIT, went down 15.8%. So these things, again, great assets, but unfairly punished. Value add, for example, usually you have a 3 to 5 year business plan, sometimes as long as 8, so you're not forced to deal with the pressures or expectations of Wall Street and Wall Street's trading. You can also be much more nimble when you have the time and patience to do those things. So we look at private equity. Private equity businesses have also done real well. This is, again, is a great alternative along with debt and real estate. But you can see private equity only had 2 down years over the last 20 years. Again, they have the time to execute business plans, and they're not forced to deal with the volatility of the public market. So there's not a lot of correlation between the two. So where to invest? Market volatility has made asset allocation a challenge for pension plans. We've obviously seen a gradual shift away from equities and fixed income, which have benefited pension plans. We have a couple of clients at TerraCap. Some are here today, Odessa Fire. A little shout out to those guys. Also our friends from El Paso Fire, looking out both sides over here. Miramar Police. They have greater allocation mixes towards alternatives than the standard allocation mix. Some of them have heavy allocation mixes towards alternatives, as much as 25-30% real estate, as much as 16 to 20% private equity. They've actually had positive years, as opposed to some of the others and what we saw with CalSTRS earlier. So it's important to maintain a diversified portfolio, but we all need to be continually searching for more stable yields and get a continual positive result with our overall cash flows, as opposed to the history of negative cash flows over an extended period of time. So long-term plans are beneficial and allows us to not be interrupted by short-term Wall Street expectations. And as I mentioned earlier, alternatives such as real estate, private equity business, debt, and other things such as timber can actually offer more superior risk-adjusted returns for the investors. And that concludes the keynote.